Hello, everyone. Welcome to another episode of Firm Returns Weekly. Got quite a bit of stuff to discuss, and it's about some companies that, well, it's not going to be on Tiny Build, which I think has been the focus of quite a few episodes recently. Yeah, a bit of a quiet week for Tiny Build news. So we're going to, thankfully, we've got some pretty big news on Aviva to pick up on, a bit of news on Taylor Maritime investment, and then a little bit on Warner Bros. Discovery as well. So I will share my screen in a second. But one thing I just wanted to mention, though, a few people comment about the t-shirts I've been wearing. Opus has appeared a few times, as well as Green Lung, I think, is another one with the goats on it. Today it's American Head Charge, which is it used to be an industrial metal band, which I first saw. They came to York when I was working as a student in a bar and nightclub there, which is also a gig venue. But yeah, it's so give them a look if anybody's interested. So like I say, unfortunately the band has dissolved. Right, so anyway, let's get back onto the business. So I'll share my screen. Right, so the big news on Aviva is there have been some takeover rumors. And this was reflected in the share price back in earlier in the month on the 6th of October, as we saw a pretty big jump. At the time, I hadn't really bothered to look too much into what had caused the spike. I think when I first looked, I couldn't see anything, but later that day, which I then went back and had a look at the last week, it turned out there'd been some chatter in various places about a takeover, and that is what had sent the price up from about £3.80 a share to £4.20 plus. But yeah, it's since come back down to sort of below £4 again, and I think that's just as the overall FTSE 100 and markets generally have been quite negative with various geopolitical news stories and so on that have come out in that time. Obviously, there was a pretty big event on the 7th of October, but I won't go into that. So yeah, let's dig into this. So I've got a link to a Shares magazine article here, which there are a few different articles talking about it, but this one I thought was quite good. Gave a few excerpts from the original sources where these rumors were first floated. And they give you an actual in this article as well, included one rumored share price, offer price that has been proposed. So I'll just read this out. So on Wednesday afternoon, which is the 4th of October, the Financial Times' Betaville blog suggested Aviva was the subject of potential takeover interest, although it described the identity of the buyer as unclear and called the story uncooked, a term used to refer to market gossip. On this morning, which is at the time of this article was the 6th of October, market report, the Times commented that the takeover chatter surrounding Aviva refused to die down, and that City sources insisted at least two potential suitors were running a slide rule over the business, attracted by its excess capital and strong cash flow. The paper reported market talk that Allianz of Germany, Intact Financial Corporation of Canada, and Scandinavian group Trig were considering their options, along with an unnamed US insurer, with at least one mulling a 600 pence per share proposal. So that would be more than 50% above the current share price. Personally, I hope a takeover doesn't happen, as I think Aviva has a bright future as a public company, which I would like to participate in as a shareholder. It would also be pretty tragic for the UK to lose its biggest insurance company to foreign ownership, much like it's lost some of its big supermarkets in recent years, Morrison's and Asda being two standout examples. However, the proposed 600 pence per share, the proposed price of 600 pence per share does illustrate the company, the value not currently being recognized by the market. So yeah, this is kind of what obviously the reason I'm investing in them, because it's really got a big margin of safety there. And the fact that these offers have been coming in really does illustrate that how big that margin is. At least 50% upside from here. And if there's multiple parties, it could potentially go higher. So yeah, I mean, like I say, I'm holding it for the long term, but now that it's come back down below 400 pence or £4, I'm certainly thinking about increasing my position. In any case, because I mean, my average price I think is slightly above £4 per share, so it would be attractive anyway. I was considering when it was getting down to the doldrums in this, down to £3.80, adding. Now you've got a little bit more of a catalyst there in place that that does increase the short-term attraction for building up a larger position. Right. So yeah, the other thing we have from Aviva was on Tuesday, the 17th of October, we had they held an In Focus Wealth event. So this was an event focusing, as you could guess from the title, on its wealth business, wherein they presented their plans for the business over the next 5 and 10 years, followed by a Q&A session with analysts. It's a really interesting session with a really good presentation with loads of market and sort of general industry data. I learned a lot from it. Learned about aspects of their wealth business, that because it's only really been this year, I think, that they've now categorized. They've sort of, since the IFRS 17 and the acquisition of Succession Wealth, that they've sort of changed their business segments a little bit, and they've now, this new wealth segment is incorporates segment parts of the business that were previously in other business segments in prior years. So this is the first time I think it's been really portrayed, and I'm sure you'll see similar things in the annual report coming up for 2023 as well. But yeah, it's the first time thing that I learned about quite a few aspects of the business that I didn't know about, and it was really interesting to see, and very promising, as you'll see in a minute, the future growth prospects for this part of the business. So the following slide, taken from the presentation, shows you how they've performed in the last 5 years and what they're expecting to achieve by the end of the next decade. So obviously we've had a fair bit of disruption in the last 5 years, and there's no guarantee we won't see more disruption in the following 5 years, especially with the geopolitical tensions now underway. But over the last 5 years, we've seen around about 9% compound annual growth rate in net in assets under AUA. I think it's basically assets under administration, assets under management. A little bit unclear exactly on what the A at the end is there. Usually it'd be AUM, but anyway, let's just assume it's assets under management. So yeah, there's quite a nice growth up to 2021. It's come down a little bit since then, but we're still getting net flows so very substantial each year. And they break down this into, because quite a bit of the current business is workplace, or the majority is workplace pension schemes, for instance. So direct contribution schemes, which are then managing, they get the income from the fees, which is pretty small. The actual thing, 0.4% or something like that, or no, I'm probably messing up, but it's a pretty low fee. It's significantly less than 1% fee they charge on that. And then obviously there's the funds that get invested in will charge fees and so on as well, and some of them they do manage. Some of them are their funds and so on. But yeah, so a lot of this sort of like net flows comes from 95%, I think, for the workplace pension business is people adding into their pension every month. So it's existing customers. They're not reliant on to grow this pot. They're not reliant on massively on getting new people for this growth. They're already 95% of the new of the net inflows come from people adding to their existing pensions as their salaries increase and so on. So inflation obviously contributes towards this and so on. They capture the upside of inflation with people's salaries rising as well. Yeah, and you can see the operating profit has grown quite nicely over that period as well. And last year was 124 million. So their ambition for 5 years from now, 2027, will be to have 250 billion pounds or more of assets under whatever A is, let's say management or administration, and to have 280 million pounds or more of operating profit from this segment. And then going out to 10 years, they're looking to get at least 400 billion pounds of assets under, say, administration, and 500 million pounds or more of operating profit. So historically, we've seen a similar ballpark kind of growth rate over the last 5 years, but 4 years actually. But yeah, if we look into the future, we actually have some underlying market growth fundamentals which should support this, and they're looking to see basically a very similar 10% compound annual growth rate is forecast for overall UK wealth, the overall UK wealth market, assets under administration by 2032 as well. So that's sort of what's underpinning this, I guess. And Aviva's thinking they will capture the upside from the other thing, and obviously with the 10% plus, they're hoping to expand beyond the underlying trend here. But yeah, this is the underlying fundamentals, and it comes from, there was quite a few different sources they've drawn this forecast data from. So it wasn't just like, them pulling these figures out of thin air. They were quite substantial sort of backing from them. But anyway, some look here. So yeah, and just to put this into perspective, if they were to achieve their growth ambitions for 2032, the earnings yield on the current share price of, let's say, in this case, I just said £4 a share, from the slightly less than 400 shares. I said 11 billion pounds market cap from the wealth segment alone would equate to around about 4.5%, which is more than half the current dividend yield. So yeah, it's an awful lot of potential here that this could end up being a sizable part of the overall business, and not to mention that the other aspects of the business hopefully will still grow as well. So yeah, you can really just see a potential for earnings of Aviva to grow very significantly, more than in 10 years. It could be the overall group could at least double over the next 10 years on these. I mean, this particular thing here would be like as you saw in the next one, could be like a triple over the next 10 years, but and actually more than a triple if you took at the profit. But for the overall business, maybe other segments won't grow quite as much. Maybe we sort of 2 to 3x, which already for a very cheap company, where the dividend yield is over 8%, is quite attractive to think that it could be 2 or 3 times that in 10 years' time. So yeah, that rounds up Aviva. And like I say, that's why, with this kind of prospects for the next 10 years, is why I would like to remain a shareholder and hold on to it. But if it gets acquired, it gets acquired. But we'll the acquisition at least gives you an idea of maybe where the shares should realistically be trading right now. and what they would go for in a private market transaction. So, Taylor Maritime, we have just a quick one here. It's they've released a 49-page ESG report, which provides, amongst other things, some interesting details around the current specification of both the TMI and grind rod fleets. So, see if I can get this up. Yeah, some interesting stuff in here. Obviously, it's going to cover the whole spectrum of ESG, but there were some interesting bits, introductory sections actually, gave a bit more detail about average EA, age, number of port calls, total tonnage carried, all these kind of like, interesting metrics to see. And you can see how the grind rod acquisition has really pulled down the average age of the overall fleet from 12 years for the TMI down to a combined 51 vessels of 10 years. And you can see all the routes they do and the sort of percentage for these different areas. So you can sort of maybe get a bit more of an idea about how exposed the company is to certain things. It looks like they don't really, there's not really much going on through here, which is obviously a good thing right now, to not be going through a particular section of water right now. And yeah, there's quite a bit of stuff in here. Let me just get down to there's also a section on grind rod. Yeah, so you get a bit more of information about the grind rod fleet. And I think there was some talk in here. There was an interesting section where they were talking about some of I think they've got a new vessel they're commissioning to be built, and I think this is where things will go in the future, where they're commissioning ships that are actually going to be ammonia ready. So, which was kind of an interesting thing. I'm not sure if I can find that now. Yeah, they've basically got a new, and I think that's where things are going to go long term, because that's presumably going to be carbon neutral. The ammonia will be made using hydrogen that's come from various sources. It might be white hydrogen they're getting out of the ground, or it might be carbon capture hydrogen or whatever, or from electrolysis in locations where there's excess energy or whatever. So yeah, that's an interesting report. I think it's going to give some good insights beyond just general ESG stuff, just into the overall mix of the cargo, everything. They give a lot of good stuff in here, so I'm looking forward to getting into this in more detail myself. So finally, we have Warner Brothers Discovery, and they currently have a publisher sale on Steam. And so this is like taken from the Steam homepage. They've got the banner across the top right now. And then they also have that banner then links to a publisher sale page where you can see, and they've break down various different franchises and stuff like that. And you can really see all the different games that they own. But what I thought it'd be interesting is just to pull out some stats from the Steam database, and we can see that it has really been already, the sales has been seeing a nice little boost to the sales of some of these games. Obviously, some of the discounts are much more substantial than others. Like Hogwarts Legacy is only getting a 30% discount, bringing it down to sort of £35 for the base game. And this game is still incredible to see how well it's selling. It's still number 15, and actually there was I've just shared on Twitter actually, but I just saw it unfortunately after doing this article. But yeah, there's an article I read giving the September monthly data for the UK in terms of, it includes digital and physical game sales, so it covers all console sales and everything. I think it's called the Game Stats Database, something GSD, something along those lines. And it's a European project. All the different publishers and platforms all contribute to. So you get all the figures from sales figures from Xbox, PlayStation, Nintendo, etc. And we can see that Hogwarts Legacy is holding its own in 5th place still after all these months in September. And I think the game originally came out in February, if I'm remembering correctly. And then Mortal Kombat 1, which I haven't listed here because it wasn't in the discount, is still holding its own. It did well last month in 3rd place in overall UK sales. So some interesting insights there to the UK market, which obviously isn't the global market, but gives you some idea. And it is a big market for sales of computer games. And so yeah, just to give you a list of these titles, we have of the ones that were on sale and what it's done for them. So we've got some quite old games in here, like Middle-earth: Shadow of War, which came out quite a long time ago. Same with Batman Arkham Knight, Injustice. All these games came out quite a while ago, and they Injustice 2, sorry, and they still made it back into the top 100 sales list. So it just shows how the popular titles can continue selling, though granted they'll be applying quite substantial discounts. So there's probably like 80% more for quite a lot of these older ones. But yeah, so we had Hogwarts Legacy in number 15, Mortal Kombat 11 in number 20, Batman Arkham Knight 21, Middle-earth: Shadow of War number 40, Lego Star Wars: The Skywalker Saga number 50, Gotham Knights number 55, and Injustice 2 number 90. So yeah, pretty good to see them being raised back up again. And then the sale drive, and I mean, you could see as well in the concurrent player counts, a lot of these games that have pretty low background sort of levels of play on Steam really getting pulled up substantially into the thousands of concurrent players again from these sales figures. That just adds further evidence to the sales they've been sort of achieving from it. So yeah, it's the game business, it's certainly strong, Warner Bros. Discovery. And I think Hogwarts Legacy as well has got like a 90% plus positive rating on Steam, which is pretty incredible for a AAA game to do quite so well as that. And I think it really is going to give it a long life. They're going to be getting money out of this game for many years to come, just like Batman Arkham Knight and Middle-earth: Shadow of War and so on. So right, that pretty much wraps up this episode. Thanks everyone for watching. Go check out the article over on firmreturns.com, as you can see at the top here. Yeah, have a look on Twitter. I posted a link to the article I mentioned with the number 3 and number 5 positions for Mortal Kombat 1 and Hogwarts Legacy in the UK game sales database. So yeah, follow me on there as well. And yeah, if anybody watching this is their first time watching it, please give it a like, give it a subscribe. Let's try and get the YouTube channel growing a bit as well. So it's growing quite nice up to this point, but it's certainly slowing down a little bit, and it's not as big as my newsletter following as well. So it'd be good to try and get a bit of a balance there. Anyway, thanks a lot everyone for watching, and I will see you all in the next one.